Welcome to the investment meeting for June 2012, and let's just quickly go around the room and introduce ourselves for the record.
Good morning, everyone. We're representing Commissioner Kelly.
Gary Dennis, SAS. Dan Torelli, PBA.
Joe Alejandro, PBA.
Chris McGrath, PBA.
Bob Ganley, SBA.
Lou Jarko, LBA.
Robert Ungaro, counsel to the LBA.
Roy Richter, CEA.
Michael Palladino, DEA.
Kenny Sparks, DEA. Paul DiGiacomo, outside DEA.
Bob North, Actuary.
Yvonne Nelson, Controller's Office.
Kathy Martino, Controller's Office.
Barry Miller, Comptroller's Office.
Martin Gantz, Controller's Office.
Seema Higurani, Controller's Office.
Thaddeus T, Controller's Office.
Larry Schloss, Controller's Office.
Bob Goldrich, Mayor's Office.
Ryan Nagaswamy, Mayor's Office. Janice Emery, Office of Finance.
Kevin Holloman, Police Pension Fund.
Captain Bernard, Controller's Office.
Just say the professor, we'll get it.
Speak up, most important person here. That's right.
There. Bobby Catanaro, Pension Fund.
Danny's greatest hits.
Bridget LaCroix, Goldman Sachs.
Okay, with that, we will turn it over to the Comptroller. Larry?
Thank you. Let's start with the quarterly review. Although events in May have sort of made the quarterly numbers reasonably meaningless, but we'll go through them anyway, so let's do reasonably quickly. Martin?
Yes, so hopefully everyone has a copy of the quarterly report. If you don't, we have a few copies here.
I need one. I'm sorry.
One more.
I'll get one more.
Thank you.
We're not sold out.
You sure?
It's a very popular read.
So as Larry mentioned, we're going to be talking about April, May a little bit later, and in fact last month we talked about March, so this is a further review about what we talked about last month. So I'll be hitting the highlights, and the world of the quarter ending March has actually moved on. The risk on has turned into risk off, as Larry described in a moment. But in the quarter ending March, which is what we're here to talk about, there was significant improvement in the stock market, as you'll see, along with other risky assets, even in Europe. And the quarter ending March saw all this. The Russell 3000 was up over 12%. Emerging markets was up over 14%, and the EFA, which includes the troubled Europe region in the developed market space, was up over 10%. Investment-grade fixed income was roughly flat as investors sought risk again. Again, this is the quarter ending March, not today, which is, as I mentioned, the reverse of what's going on right now. And high yield was up 4.5% as investors sought returns in risky assets and higher yields. In all, this brought the returns for the fiscal year to date and the one-year results over the positive territory, as you'll see on page 20. One last thing, and Seema will expound on this a little bit more. In the U.S., small cap, mid-cap, large cap, all roughly were in the 12 to 13% range. The difference really was that growth beat value, which is not uncommon when investors are looking for returns when risk is back on. So if you turn to page 20, you'll see the overall returns for the portfolio for the full police fund, which was valued at $25.6 billion as of March 31st. And the return for the quarter was a very strong return on an absolute basis, 7.25%. That was 60 basis points behind the benchmark, and as I mentioned, it brought the fiscal year-to-date and 12-month numbers back over positive territory. The three-year number, you see the bar going much higher at 17.01, while it is behind the policy benchmark. The return now, because it now goes past the three-year return, goes past the troubled time back at the end of 08. It's not in there, but you see it's in the five-year number, which is why it goes back down to 316 for the five-year number, and gradually goes back up to when 15 years is nearly 7%. The next three pages show what we've been showing the last several months. In fact, since the board adopted the new asset allocation. The first page on page 21 shows where we are versus the old policy weights. Where we are versus the new policy weights is on the next page, page 22. And because we're not fully invested in those new asset classes or increased asset classes, we have adjusted policy weights, and that's shown on page 23. And that's really the key. The top part of the page, the pie chart, is identical because where we're invested does not change, but where we are versus the policies change. So if you turn to page 23, and again, Larry went through this last month, you see that we were a little bit overweight on the equity side, a little bit underweight on the fixed income side. The only asset class that was out of balance was TIPS, and opportunistic, which is shown in purple. I think it looks like purple to you, pink, purple. We are slowly legging into the opportunistic fixed income area as we sign deals and as the managers call down the capital because the investments are there for them that meet the requirements of the program. The next few pages show attribution of return, breaking down the allocation effect and the management effect. The summary of that is on page 27. Pages 28 and page 29 were inadvertently duplicated. Normally what we do is we show on page 28 how you look versus other large public funds, and that's defined as greater than $10 billion. And we show each quarter, most recent quarters on the left, and each year ending March 2012, March 2011. And you'll see for those quarters where the numbers are. You'll notice for the quarter ending March 2012, this is now sort of the mirror towards the right. The ranges were very, very narrow, very, very narrow. And then it becomes more wide for 2010 and 2009. The annualized numbers, which are not shown here, I do have those numbers here with me. Of course, hidden under the table. And those numbers, basically the annualized numbers, put those numbers together such that the 3-year number, you're just outside the top quartile of the 28th percentile, 4-year number, the 34th percentile, the 5-year number again in the 28th percentile, and 7 years in 31st percentile. So just outside the top quartile, so the numbers annualized reflect those returns. Unless there are any other questions, I'm going to turn it over to Seema for a brief discussion on the equity portfolio.
Just a couple of comments, Martin. Could we, as I've mentioned in other board meetings, add a line in the asset allocation section for the percentage in liquid assets?
Yes, so that's a work in progress. We're working on that, and we expect to have that for you very soon. Part of the issue that we're working on, and we'll work with Barry on this, is to define what's illiquid. So we may have different categories of illiquids, and we will talk about this with the consultants and talk to the boards once we have something to present, which should be very, very soon.
Great, so we'll first review what we're calling liquid.
Exactly.
It won't be one number. There's different levels of liquidity. So you'll see. We'll send it around and we'll get happy.
As long as it's one number across all the systems.
We are going to work with all the consultants to get a number that makes sense for the systems.
And Martin, I'm just trying to understand the performance attribution charts.
Sure.
And I'm looking mainly at the longer-term attribution on page 26. And I'm not seeing I see the detail on page 27 that shows where we've underperformed in active management, but I'm not seeing the detail that shows how we've underperformed with regard to being off of our policy. So I'm trying to understand that, as well as understand what effect our cash holdings have had in terms of performance over the past 3 years.
So to take your first question, much like the illiquid page that we're going to be adding, the allocation page breaking down what we show, the management effect, how the managers did versus the benchmark, is a work in progress with the bank, and we just weren't quite ready for this book, but we certainly hope to have it in the next book. And we'll be talking also to Barry to make sure that corresponds with the numbers that he calculates, because when you do attribution, while the formula can be fairly simple, there can be large residuals, and so we want to make sure that we capture everything. And when I say residuals, because if you're doing a transition and moving assets from one class to another, sometimes things fall out of the calculation. And so we want to come up with a number that makes sense and corresponds to the individual, to the total that makes sense. We don't want something with a residual that is too large, that everything else falls into. It should correspond to the numbers in each asset class in an easily explainable format. And that's a work in progress, and we hope to have that for next time. As far as your second question about the cash, in fact, did have a drag for the period of the last year, although the allocation effect, and the preliminary information that we've gotten, because this, as I mentioned, this is a work in progress that we're doing with the bank, the preliminary work that we've done is it's not the full allocation effect. We were also underweight fixed income. As you'll see later on, fixed income, let's say for the year, I'm looking at page 25, for the 12-month period, the return at policy rates was 4.66. Fixed income did better than that, and we were underweight. So that also had an effect. So we will put all those things, tips, 4+5, all of the allocation effects and the decisions on where we are underweight or overweight and where it helped or hurt. When the market was up and obviously had a positive number for the one-year number, part of that allocation effect was due to cash. And we will have that for you, and I fully expect to have that for the next one.
Great, thank
Can
you.
I ask you a question on, you raised a question about illiquid assets. Now, doesn't that really depend on current market conditions? And I only ask that because, I'm a trustee on my annuity trust fund, and back in 2008, 2009, we had AA, AAA paper that we couldn't liquidate because it was illiquid. But that's really subjective and subject to the changing economic times that we have, and that's like almost on a 24-hour basis. So I'm really not clear insofar as why that would be. It's important to figure out what's illiquid and what's subject to the J-curve and private equity, but it seems like that's defined in the package that's given to us now.
So if you remember our asset allocation discussions, Roy, Barry had, maybe I should turn this over to Barry quickly, but we had looked at every asset class and said, over cycles, what sort of illiquidity does an asset class exhibit? And so we looked at opportunistic fixed income and said, is it 50%, some X% illiquid, some percent liquid? You're exactly right. When correlations go to 1.0 and markets freeze, everything becomes illiquid. So we could look at a scenario like that, but this is simply to give us a sense of, since this portfolio is still needing cash flows and has cash flow needs, on a growing concern, on a normal markets basis, what should our percentage of liquid be? One way I think about what you just said, and Larry and I actually had a conversation in this room about it, is in a normal market, you want to have something like 20 to 25% max illiquid, because when markets freeze, half the portfolio becomes illiquid. So you can't start out by saying, I can have half my portfolio liquid, because when markets freeze, 2/3 becomes illiquid, if you see my point. So we have to still manage the liquidity of this program, which we've never paid attention to because there's been enough cash flows. But as we start investing in bank, they're doing more and more privates, more and more illiquid, and not to have that number that says in normal markets, here's your illiquidity, and I like what you're saying, in stress markets, here's what that number could go up to, is a useful exercise.
So you're looking for a category that basically identifies assets as illiquid based upon historical norms?
And I think I like what you're saying about also adding a line that says, and in stress periods, high-grade corporate might become illiquid too. And as a trustee group, we should just have an eye on what those numbers are.
So what you're advocating for is like a stress test? Of the
Yes.
fund? Do we have that capability to do like a stress test?
Well, it's sort of an intuitive back-of-the-envelope test. Barry, do you have any comments?
I think, you want to identify what's illiquid so you know what's liquid. So 1 minus the illiquids is the illiquid. And then you want to look at what your net cash flow needs are in a year. So benefits minus contributions. And that becomes the numerator. The liquid assets become the denominator. And as a rule of thumb, that ratio shouldn't be higher than 10%. I think that's really what I'd be like to looking at.
And is that something you've done for other funds?
Yes, sir.
Well, one of the things that we're going to do, it's not a number, right? So we're going to put together a schedule that has what I'll call the aging of our assets. So some things like hedge funds have one-year lockups. So we should know how much of our assets are in one-year lockup versus when the lockups end. So we're going to try to put that in the schedule. Add that number to the totally illiquids, which is real estate and private equity. That gets you a number. That's the stuff you look at. No matter what you do, you really can't get out of that without hurting yourself on a valuation basis if you want to sell private equity. You add to that some portion of our opportunistic fixed income is going to be in illiquid things. So we should come up with a guesstimation of that. You add that together, and go through the rest of the assets and see if there's anything that's what I'll call contractually illiquid. So for instance, next couple of months we're going to give you things like private placements of debt, illiquid. Add that, and we should all know what that number is. That's a number. And let's call that the bedrock illiquid. After that, you get into the more subjective, to your point about cycles. And I think we can do some good work on, if this is your portfolio, this much could be in stress. You can go from liquid to illiquid. But I want to be able to track it monthly like we track the basket clause monthly, so everyone knows where we are, so that when we get back into stress periods, we'll keep track of this number. But again, it's taken us a little while to get it to the shape that we wanted it, because again, it's not a number, and I want everyone to understand the components of the number, because that's, as we make more allocations to things that look illiquid, there's some number of ways to say, look, that's enough. We can all discuss what we think that number is, but before we discuss what's enough, we should all appreciate where we are. So I think hopefully next month, we'll have the beginnings of it. I'm sure, like everything, we'll refine it a couple of board meetings. When we're done, we'll all say, okay, we've got that page, we know exactly what it is. We'll talk about it every now and then, depending on where it is in the stress cycle. But it's a good thing to have that we haven't had some of these analytical tools that we're working on.
I also want to make a point that a lot of times you look at the basket and say, okay, that's a liquid, but the basket is simply a function of the law, and the law also includes items that go in the basket that are perfectly liquid. So it's not necessarily connected.
So will we have that for July's report?
We expect so.
July's report. And then last question, Barry, we had requested your independent view on attribution.
Okay.
When will we have that?
Well, we ran the numbers for 12/31, and I talked with Larry, and the agenda was sort of packed, so right now it's on the agenda for July. We'll see how the agenda is, and we'll rerun it for 3/31 numbers.
That's sort of a board priority, so if the consultant's ready with some stuff, I would just like a discussion, Larry, because those are things that we should see more than sometimes these packages on a monthly basis.
If I could make a comment on the attribution, Janice, I think the big number, and particularly on a 3-year basis, is the management effect in private equity. I think that's the biggest negative number. And I would say that your benchmark, 500 over Russell 3000, is a very aggressive benchmark. So I would downplay that shortfall, because that number should be something like Russell plus 350, around in there. That's what others are doing. Ideally, we would use more of a peer group like we do in real estate to bench the private equity. I know there are problems with that, and not many other plan sponsors have adopted a peer group benchmark for private equity. But I can tell you 500 over the Russell is a very aggressive benchmark for private equity.
Well, it's just not a short-term benchmark, right?
Correct.
So
But even-
we need something different, like a top quartile
Yeah.
benchmark for less than 3 years.
But even if you're using a public equity index plus premium, your premium is way out there.
So we're going to talk about that next month, Barry?
Correct.
Because we agree with you, the 500 over a floating rate is just not, doesn't really help you at all. Doesn't give you any long-term or short-term.
And that's about 100
What's going on.
basis points on the total.
Okay?
Okay, so I'm turning it over to Stephen for
Thanks. So if you turn to page 32 in the quarterly book, Martin already went through some of these numbers already, but you can see here the domestic equity returns up over 13% for police versus the index. which is up 12.87%, so doing a little better overall than the benchmark. In fiscal year-to-date, though, slightly behind the benchmark, and there were some couple manager-specific issues there that we can talk about in more detail. So we turn to the next page, 33. Again, this is just the quarter. But this gives you a sense between small, mid-cap, and large-cap U.S. equities. And I'll point you to just a few columns. So the index return, the actual return, and then the difference column. And Martin mentioned this earlier, but you can scroll down a few rows, and you can see that the mid-cap S&P 400 index was up the most in the quarter, 13.5%. But small cap and large cap were close behind at up over 12%. If you look at the difference column, I'll just highlight one area here, which is mid-cap active, outperforming for police by close to 300 basis points. And a couple things for police went well there. Mid-cap value did especially well. Your managers, Iridian and Systematic, and then mid-cap core did well also, and that's Wellington. Group also outperformed, less so than value and core, but also did outperform, so that was a good attribution for mid-cap for police. If you turn to page 41, we'll talk about international equities. And here again, I'll just point you to these same columns, the index return, actual return, and then the difference. And Martin mentioned this also earlier, but in Q1, Europe, IFA did well, and emerging markets did very well. So emerging markets were up over 14%. You can see that down in the passive EM row. And then IFA was up close to 11%. And so this was all when there was more certainty about the bailout for Greece at that time. And the euro strengthened during that time. Of course, all of that's different now. But in the quarter, we had some good performance internationally. And then in the difference column, I'll just highlight a couple things. So IFA value had a tougher time in the quarter. It's really Mondrian and that manager had a very tough time. In the quarter, longer term, they've done a little better for police. And then another thing I'll point out is non-U.S. activists, so up close to 500 basis points relative to the benchmark. That's your activist manager, governance for owners, and so those guys had a strong quarter for police. If you then turn to the next page, 42, gives a little more detail on IFA, and you can see the trailing 3 months in the quarter basically in line with the index. Fiscal year to date, again, a little better, but basically in line. But if you look out over longer term periods, the trailing 3 and the trailing 5 year, the police portfolio has done a little better than the index overall. If you next turn to page 46, there's some more detail on emerging markets. And there you can see that in the quarter, police did a little better versus the index fiscal year to date, a little bit behind. But over the longer term periods, the trailing 3, trailing 5, trailing 10 periods, police did a little better than the index. And I'm going to back you up just a little bit. They're a little bit out of order. We'll change this. But if you go back to page 40, the hedge fund returns got mixed in into the equity group. So if you turn back to page 40, this is still early days for the portfolio, but you can see in the trailing 3 months, the hedge fund portfolio, again, it's just a few names and then from all. A bit behind the HFRI Fund of Funds Composite plus the 1%, which is our benchmark. If you look in the fiscal year to date, we're actually doing a bit better than the benchmark. And then the 1-year T-bill, the yield plus 4%, that was the longer term over a cycle kind of benchmark. So it's still early days to really compare to that one, but it is one of our benchmarks as well. And now I'll turn it back to Martin.
Thank you. So, starting on page 50 in your book, there's a discussion or a pie chart that shows the entire allocation to fixed income. And of course, that's dominated by the investment grade 4+5 program, shown in green at 57%. total fixed income was at 32% or $8.2 billion. Breaking down the Core Plus 5, largest component is on the next page. And in the over-under column, you'll see on the left, sort of in the middle left, you'll see we were underweight and have been underweight treasuries, agencies, and overweight mortgages, and now slightly underweight credit. Part of that is market movements. This helped in the quarter ending March, and we'll go in reverse for the quarter to date. But for the quarter ending March that we have here, treasuries and agencies underperformed and had negative returns as investors fled to riskier assets. So that helped the allocation. But more importantly, on the difference column, each of the sector's managers added value over the benchmark in this environment. So that's good news. So when you take the allocation and the fact that managers added value over the benchmark on page 52, the program itself, which is 18% of the total piece fund, all the way on the left, while I can't compete with SEMA's equity numbers for this quarter, the return for the Core Plus 5 was just over 1%, 63 basis points ahead of the benchmark. I also want to point out on the bottom, I've been pointing out for the last few quarters that the volatility is in the 4 to 5% range, but actually in the last 3 months, or the first 3 months of this year, volatility really went down, and the volatility was in the 3% range, and that's partially due to treasuries and agencies being in a trading range, and also mortgages, which have volatility that's a sub 3%. So the volatility has come down quite a bit, hence the Sharpe ratio has gone up. For the fiscal year to date, we have positive numbers at 663, just ahead of the benchmark. And for the last year, we're very strong numbers, 922, just behind the benchmark. 3 years, which now excludes the bad times in 08, which, by the way, helped the Core Plus 5. But nevertheless, those numbers are now 901, over 100 basis points ahead. And the longer-term numbers are in the 6.5 to over 7% range, as they have been for quite some time. So the numbers here are good for the Core Plus 5 program. TIPS, similar thing happened. The returns were slightly positive, a little less than 1%, slightly behind the benchmark by 7 basis points. But if you look at the table on the bottom for volatility, the 3-year volatility has markedly declined, and that's partially due to the fact that we're near zero yields, and so the volatility has simply died down in this sector. Historically, the volatility is higher. The returns themselves for the fiscal year to date, over 8.5% ahead of the benchmark, and for the 1 year, 12.3, obviously very healthy. Now, you think of TIPS, you think inflation. Did we have 12% inflation? No. The reason the returns are higher is because there are 2 components to the return. One, of course, being inflation, which was, as Larry will go through the charts, in the 3% range. So what happened to the other 9%? And that's duration. As rates have come down, bond prices go up. And rates have gone down so much in the TIPS land that real rates, which is what we look at in TIPS, are actually negative out to 12, 13, 14 years because of the demand for TIPS from investors. The returns going out since inception, which is 6 years, are roughly in the 7 to 8% range, slightly ahead of the benchmark in 3 years, right on top of the benchmark, 1 basis point behind. For high yield on the next page, as you know, we made some decisions last month, but the program returned 453, which is a sign that investors are seeking yield and risk is back on. That has reversed this quarter. The return of 453, 463 is 9 basis points ahead. Fiscal year to date, that brought the return to a stronger positive number of 525, and the 12-month as well, 642. The 3-year number is really where you see what high yield has done. And again, this excludes what happened the last quarter of 08, and the returns are 1890, slightly ahead of the benchmark. But even when you include the bad numbers in 08, which is the 5-year number, the return is 796, just short of 8% and 200 basis points ahead of the benchmark. And also ahead of that for 10 years. So the returns have done well. On the bottom, the standard deviation of the volatility is below that of the benchmark, and also has died down as the other fixed income volatilities have died down. That does not mean that that's there to stay, but right now that's, or at least according to March, that was the rules of the road. Convertible bonds are on page 55. The returns are underperforming the benchmark because they're very highly correlated with equities and have strong results on an absolute basis, which are 8.01%. And in the executive session, we'll be discussing convertible bonds and convertible bond managers. For the fiscal year to date, you don't even see the bar chart because it's effectively 0% return. It's 0.04, behind the benchmark by about 1%. And longer term as well, behind the benchmark, the one-year number is roughly flat. And the three-year number, while very healthy at 1592, is still behind the benchmark. Again, we'll be talking about this in executive session.
Mark, when the converts are so highly correlated with equities, should we move them to the equity bucket?
That, I think, is a conversation that we should have with the consultant. To give you some background, when we first established this program, we decided to put it in the fixed income program. In case you're wondering, New York State law considers convertibles to be equities, but the reality is they are bonds, and traditionally the managers that manage convertible bonds are the folks that talk to the high-yield teams, but they do have, obviously, connections to equity, so it's a true hybrid investment, and you can make arguments either way, so that probably is a separate discussion. And maybe Barry wants to weigh in on this.
In the asset allocation study, we grouped them with high yield because having a 1% allocation doesn't make
Or
any
a size
sense
issue.
at all. Right, more of a size issue.
But as an asset.
But the actuary considers them to be bonds, so they reside in two different places in that way.
So we won't resolve it today. Exactly.
So the question
Very
is,
clear.
while the law says they're equities, what are they and what should we call them? Because they have high correlations to equities, but they are classified presently as fixed income. So we do understand what you're saying, and we can talk more about it.
To clarify on Barry's comment, you go back to 1995, when the boards moved to 70% equities, 30% bonds. The choice of what was considered a bond or an equity, well, there were no convertibles around, but when the time came, the characteristics could be either. The name bond was in the thing, and so for the purpose of what the actuary had divvied it up, it was placed there. Economically, it's the same issue with high yields. They're kind of an in-between, and when you do your asset allocation, you put in the proper characteristics and so on. Today, the boards have already moved to, across all five systems, have moved to asset allocations that I think are both below the 70% of what are traditional equities and have been more precise about spreading out by risk characteristics the definitions of what is and is not a growth equity type asset versus a return of capital bond type asset, and that's just an increasing sophistication that has occurred over time. So yes, it's all the actuary's fault.
We got to the end real quick. It's all your fault.
You could have inserted that right up front, Joe.
Page 56 shows opportunistic fixed income. And as you know, we're moving, first of all, we're investing more, and we're moving from purely fund investments to more strategic, dynamic relationships. And in this period over the last 3 months and the last year, several of the funds, the older funds, have been winding down. And in fact, next month when we talk about the annual plan for opportunistic fixed income, we'll be talking about some of the funds and final reports on them. The biggest one, namely, is PIMCO Disco. Going back 3 years, the return is 23.14, and there are two benchmarks. It's the high yield, a global high yield plus a premium, as well as 10%. And then, of course, we go to Kathy, talking about ETIs, and Kathy will take you through that.
All right, good morning. Your ETI portfolio reminder is shown net of fees, and while it underperformed for the fiscal year and the trailing 12 months, it did outperform its custom benchmark for the trailing 3 months, 3, 5, 10, and 15 years. It's what we do expect from this portfolio. Now I'd like to turn your attention to the collateral benefits, which are in this board package, starting on page 7. I'll just give you one brief highlight. It does show you where your investments are having impact in New York City. I will just tell you, in the multifamily program, you invested $5.5 million in Bronx, Brooklyn, Manhattan, and Queens for 288 units of affordable housing. Any questions? Thanks.
So moving on to the real estate portfolio, in the board book, it starts on page 16. Just want to give you the highlights of performance for the fourth quarter of 2011 for the real estate portfolio. The return for the portfolio was very good. It was 4.4%. It outperformed the benchmark by 170 basis points. The Odyssey came in at 2.7% for that particular quarter. The market value of the portfolio was $614 million. We had commitments that we had yet to fund approaching $300 million for a total exposure to real estate of $908 million. So just talking about the recovery in real estate, which we've kind of lost some momentum based on what's happening U.S. and globally in terms of macro events. However, there are some encouraging signs in real estate. We've talked about the very robust interest in core real estate. That's the real estate that is, delivers a high current return, fairly stable, gateway cities. And there is credit available for those type of properties. While the CMBS market is still struggling, life companies are having quite a banner year providing debt to real estate investors. Transactions have certainly increased in 2011. Real Estate Analytics reports that there have been $220 billion of transactions in real estate, and that's over a 50% increase over the activity in the previous year. In terms of our performance, thank you very much. In terms of our performance, in the near term, we're doing pretty well. I talked about it for the quarter. In terms of the year, the portfolio is pretty matched up to the Odyssey benchmark, 15% versus 13.6%. In the outer years, we have some sustained underperformance, and that's predominantly because of the performance of the non-core managers that simply kind of took a real long skid, long time to break in terms of investing in the height of the market and kind of slow to put the brakes on. So if you kind of look at the 3-year and the 5-year, those quarters have to kind of move through the system. But as you can see in the near term, we're doing pretty well. Going on to page 18, the police portfolio has a 6% allocation to real estate. I talked about our exposure being close to $900 million at this particular point. If you look about how the portfolio is constructed, it's about 36% core and 64% non-core at this particular time. We have 39 fund investments. We're working with about 27 managers at this particular time. And in terms of activity that we've had since fourth quarter, we've been busy with some new commitments, close to $200 million for the police system, and that being a $70 million commitment to DIVCO, $100 million commitment to Blackstone 7, $65 million to Almanac, and $60 million to Brookfield, all committed and all closed, by the way. Moving on to page 20, just want to kind of give you a sense of the diversification of the portfolio by property type. So in terms of the property types, and just a little word on the property types. So we have apartments. Apartments is a sector that was the first to recover, and occupancy is growing, rents are rising, and we're almost at the point where we're starting to see people actually start to build in apartments. But other sectors, such as office, is not as strong, but definitely improving. Industrial has had an uptick this year, and that's kind of based on good activity in manufacturing and some of the good things we've been seeing in the tech markets. Bringing up the rear is probably retail. I mean, you need a healthy consumer for retail to kind of come back, but meanwhile, the malls are doing very well. Down at the bottom, you see diversification by geography, and you'll notice that the non-U.S. exposure that we currently have is about 13%, and we're going to talk a little bit further on real estate trends in Europe a little later on in the agenda, but if you have any questions on what we just talked about, just feel free to answer. Thank you.
Okay, and with that, we're going to go into private equity, which is on page 25 in the big book. Again, I'll be brief because it is almost 6 months old as we talked about it. So a couple things to highlight. First would be the secondary sale, which we've talked about in previous meetings. If we look at that, the police pension fund sold interest in 4 partnerships, roughly 70-odd million in commitments, and those numbers are just rolled together. So if we look at today, or as of December 31, 102 managers, 146 funds. Returns remain pretty consistent, 1.29 times, so almost 1.3 times your money. 9.5% IRR. The number I would focus on is a number in the book that says DPI, which is dollars paid in. So what that really means is you're starting to get more money back. So you went from 0.45 times your money at the end of September 30th, 0.49 times your money. So what that means, you've got roughly half the dollars back you put into the asset class have come back. So that's an important statistic as the portfolio continues to mature. If we go on briefly to page 26, this is the relative performance versus the benchmarks. Barry touched about this a little before, but based on the existing benchmarks as of today, again, the portfolio 9.5%. The Russell 3000 plus 500 is 9.9. That is a benchmark, again, we're going to revisit. If you look at the other benchmarks that are in the policy statement, so the median Thompson 1, or what was venture economics, 3%, so significant outperformance from there. Top quartile, 11.3. So moving in the right direction. If you go to page 36 in the book, this just details the 4 funds that were sold during the secondary fund. Again, as I mentioned before, roughly $70 million of commitments. If you look at the new commitments that were made as of December 31, there was 1 re-up and 3 new investments. So you have new commitments to Green Equity, Summit Partners, and American Securities. There was a re-up to Vista. So in the aggregate, that was $220 million. And then post the end of the quarter again, because we are in June right now, there were 3 additional commitments made, 1 additional re-up, which brought an additional $200 million. Last couple things I would touch on, again, is if you go to page 41, this is what the 1, the 3, and the 5-year numbers look like. What you'll see is that the system has underperformed in the 3-year, the 5-year, and the 10-year. I'd mentioned this before, and I would touch on again, which is when you look at it, private equity as a long-term asset class. So what you really need to focus on is the since inception IRR, and that continues to be, while modest underperformance of the Russell 3000 plus 500, with some sort of adjustment of the benchmark, you're very much in line with the benchmark. If you look at the middle of the page, this is an interesting part. This will tell you, if you look at the overall private equity commitments that the systems have made, where have been the better performers, where have been the underperformers. A couple things I would touch on. One is we've touched on venture before. Venture has given you a 0.3 times, not really 0.3 times, a 0.3% IRR. That clearly has been a drag on the portfolio. The other area I would touch on is energy. Energy is one of these that it's a little bit unexpected, so that's giving you a 4.2% IRR, again, below what the overall performance is for the portfolio. That's not that energy is a bad space. Unfortunately, some of the managers in there have just underperformed, so that's a little bit more on the manager side than the sector side. And if you look at some of the best performing asset classes within private equity, large cap buyouts giving you 27%, so those are private equity returns. And if you look at growth equity, that's giving you almost 20%. Last page, page 43. One of the things that we've talked about is this idea of making larger commitments to fewer managers. So if you look at the statistic in here, 19 managers in the portfolio represent 47% of total exposure. If you pierce down a little bit more and you look at what those managers are on the page, 6 of those are new names. Again, it goes back to what we've talked about before. The recommendation have been larger commitments to fewer managers, more top quartile managers. And as the mix continues to change, you've got 19 managers represent 47%. You've got almost 80 managers that represent 52%. So you'll see that mix continue to change. And what we'll bring up probably in the next board meeting is we'll give you some more kind of nice pie charts and graphs that really show you how the recommendations have been there to kind of move the portfolio. But I think the summary here is that the portfolio continues to move in the right direction. The last piece is in the little flip book, which is page 58. And this is a new slide that's been added. And what this is, this shows you on a monthly basis what the contributions and the distributions look like to the overall portfolio.
What page was that again?
This is page 58 in the color book.
Color book.
Monthly.
In the monthly book. This is a new slide that we'll add every month in the monthly book. What's interesting about this is, and it's effectively, so the top line are the contributions.
Sure, it's 58?
Yeah.
Yep.
58 of this monthly. April.
Oh, okay, that one. To the quarterly, yeah.
So here, so what we have is the top line are the contributions, the top line of the distributions, bottom line of the contributions, but what you really need to follow is the green line. And what the green line is showing you kind of what the net number looks like. So what you'll see for the month of April, that it's a net positive, but if you look back for the first quarter, each month was a net negative. So if you look at it, what that's really telling you, and unfortunately this is not going to make a trend, because if we look forward to May, it's going to go negative again, is that the managers have been calling more money from you all than sending you money back. And that's the kind of the trend right now, which hopefully will correct itself in the future at some point, but near term right now, it looks like you're putting more money into private equity than you're getting back. And with that, if there are any other questions, that's private equity.
Okay, so that's a review of the quarter. We get to April now. Unless anyone has any more quarterly comments. I'll go kind of fast through April because April was grossly overshadowed by May. Things that happened in April, perhaps reported in May or recently, is the U.S. GDP is only growing at 1.9%. That's not enough to get the jobs growing. Job creation is now less than $100,000 people. Also not good enough, hence unemployment is ticked back up 8.2%. So before we were sort of muddling up, if you remember the term I used, now we're kind of muddling up slower, not good. A lot of that is caused by what's gone on in Europe. Europe, you may recall in the fall, I think it was the first or second week of December, the ECB had a plan called LTRO. They basically, in two tranches, flooded the banks with 3-year loans to get them from where we are now to hopefully 3 years to kind of get their house in order. And the problem is, in retrospect, the 3-year window is now closed to about 4 months. So people have taken the LTRO money, and now we have a problem again. The simplest way to describe the problem, or a fundamental flaw that they have to deal with is, with 16 countries that make up the euro, and if we're one country, we have an election every 4 years. The 16 countries have elections kind of in their own little cycles. So what happened in April was France changed presidents. So the French President Sarkozy was replaced, and France and Germany were kind of working pretty well together to figure things out. The new president of France, Hollande, is much more into growth than austerity, so you basically have a change in a key player. At the same time, the Greeks had an election, the Greeks being 2% of the GDP, but lots of the crisis. They also changed governments, and they're in the process of sort of phase 2 of their election. I think it's June 17th to figure out which way they want to go, but they're basically fighting about growth versus austerity, having taken a very, very big loan from Europe. The combination of those two basically has what was sort of a path and a plan agreed upon being unagreed upon. That creates humongous uncertainty, markets hate uncertainty, so that we're going to walk you quickly through April numbers, but the shit hit the fan. That's a very technical financial term. In May, and I'll give you some of those numbers as to what it looks like in May, but we don't really have all the final numbers in May. But again, these are old numbers now. They might as well be historic, given what happened in May. So, with that as an introduction, to page 20. And I can perhaps show you a little bit of what's gone on. Page 20 is the dollar-euro exchange rate. And again, this is all sort of May-ish. It went from sort of 132, 133, it hit 123 last week, which is a huge move in the span of 2 or 3 weeks, which shows you a complete lack of confidence in the euro, which meant a flight of quality to the dollar, which meant the dollar rates fell off a cliff. And again, if you go to page 25, you can see that the 10-year Treasury basically collapsed from about 1.9 to 1.45, which is sort of a historical low. It's unheard of. It's not supposed to be there. I'm happy to lend anyone who wants money for 1.5% for 10 years, but it's got nothing to do with the rate as much as it has to do with the fear of the alternative, which is the euro. 2-year Bunds went to negative for a while. Again, terrible sign. And if you think about it, this might sound overstatement. There isn't really a big crisis yet. There's a lot of fear, but it's not like something actually happened. Which is a dramatic change from what was going on in April. In April, people were feeling pretty good. The numbers that we just gave you for the first quarter, we were up probably, the markets were up 8%. We made 8% in the first quarter, which is pretty good. And then if I jump all the way forward to perhaps page 41. So January, February, March were great. April came along, it was kind of a transitionary month, but no one quite really grasped it. The stock market, U.S. stock market, if you again look at the far left, was sort of down 1%. The international markets were down 2%. Debt markets were up kind of 1 to 2%. That all translated, if you jump to our portfolio, back to the mix in a second. It translated on the next page, page 42, to sort of break even for the month of April, which meant we're up about 2.5% for year to date. We're positioned pretty much for continued recovery, if you will, from the uncertainty that happened in the fall that was fixed by the LTRO. But with these elections, and again, if you want, you can write these numbers down. Go back to page 42 for a second. And if you write these numbers down, you'll get why I don't really care very much about these April numbers. If you look at the Russell 3000, you write down in the month of May, it was down 6.2%. And IFA was down 11.4%. And emerging markets was down 11.2%. 4 plus 5 was up 1%. The high yield bonds were down 1%. And tips were up about 1.5%. So May was completely different than April, which was completely different than the first quarter. That said, if you go back to our asset allocation now, go to page 37, you can see that coming into the very turbulent May, we're still finishing up getting our asset allocation back to the switch from last June. We're a little overweighted U.S. equities and IFA. The rest were pretty much all right on the equity side. We're underweight Core Plus 5 and tips. We had a little less than 2% cash, and we were just in the process of finishing up some documentation for some of these opportunistic fixed income investments that we approved last fall. In May, right before May came, or maybe at the beginning of May, we reduced our exposure a little bit to U.S. equities as well as IFA, so that we're now sitting right on top of our asset allocation for IFA. We're probably a little over in U.S. equities, and nothing over or under, I would tell you, basically, in equity exposure as we find ourselves in June. We're a little more or less under allocated in Core Plus 5. We have a little bit extra cash, probably about 2.5% cash now, and the opportunistic is starting to kick in. When you go back to page 38, we're very much in line with our target ranges. As of April, it was sort of 68-32 on equities versus fixed income. We probably have less equities now, so we're probably right on 65-35 plus or minus. It's pretty much the adjusted policy. We have a little bit of cash. So really, the key is that next month, May, my estimate is we probably lost 6% in May. So that it gets us back to about $24 billion, so we're probably down about 3.5% with 1 month to go, which is June. So far in June, we're down a little. Equity markets are down a little. My guess is I think there'll be a little bit of rally if Greece can get to the right outcome in the middle of June, but who knows. So we probably have about 4 weeks to figure out where we stand for the rest of the year. But we gave it all back in May. So again, I think we're down about 3.5%, plus or minus a little, for 11 months, and right about now we have to get back to even, but I just don't know. And again, there's nothing we're going to do with the portfolio between now and then to make any difference one way or the other. And there's just lots and lots of volatility. The May thing sort of came out of left field. But again, we weren't really over or underexposed very much of anything coming into it. So that's the month of April and a little look into May.
Effectively, what you're saying is beta rules, and the beta of this portfolio drives the portfolio.
Totally. Yeah. Well, it's asset allocation, but it's one of these, on a monthly basis, you can get smacked up and down when you have very, very volatile markets, which is what May was. Again, January, February, March were great. Gave it all back in May. Coming out of a very bad fall. So a little bit no matter what you did, the markets are just too volatile right now to actually get what you want to do. So you kind of scroll back a little bit into your asset allocation. What the storm. So again, this is not going to go away. There's volatility in Europe. It's a very, very complicated situation that they have. And then looking further into the summer, you get the U.S. election. Too close to call. You guys are all smart enough to have an opinion as to which way that goes. And then there's this thing you read about called the fiscal cliff at the end of the year after the election, which is the Bush tax credits, tax regime expiring, and how that gets handled versus who's president matters. And you're not going to know anything about that until the election. So I think the rest of this calendar year is going to be just a very, very bumpy ride. So, we keep doing what we're doing. We keep sorting through the managers, getting rid of bad ones, making long-term allocations to the right private equity and the right real estate people. See us hiring hedge fund managers, trying to get the opportunity for fixed income managers hired. The timing on the opportunity for fixed income is going to look pretty good because, again, the backing up of these markets is good for them, but it's just, it all takes time. So, we'll see. We'll see how June ends up. But we'll probably try to give you guys a flash before the board meeting, before the normal occurrence of the numbers, because we wouldn't see the June numbers until August. Give you some idea before that, as to what we think, plus or minus a little. So that's April. That's April moving into May. Sorry to bum you all out. But now you're going to cheer us up with your
Sure. Okay. I'm going to start on page 109 in your books, the big books. And I've been over this many times with you. I think you all know that we reset our capital market expectations every 6 months, in May and November. So the new numbers are fresh. They're 5 weeks old, but they're already out of date because of what's happened in the bond market. And the other significant date is November of 2010, which was the set of assumptions we used throughout your asset allocation studies in 2011. So again, our returns are based on, we try to stay within long-term real return corridors, so rolling 5-year real return highs and lows. But we adjust them with a mean reversion tendency in mind. And it mentions for fixed income, we use the yield to maturity, yield to worst actually, and for equities, we use a dividend discount model. Now, both of those are mean reverting components. So when you use the yield to maturity, if yields go down, that means future returns go down, and vice versa. In a dividend discount model, when you plug in current dividends, dividends actually go up when prices go down and vice versa. So when markets go down, our expected returns go up because that dividend component is higher in the model. The risks are historical. Our numbers don't change a lot. They've 3 different instances in our history, which goes back to '94. We've had big changes. That's when the dot-com bubble was building and when it burst. And then this last thing about the financial crisis and rush to quality, well, that's been going on for 3¼ years already. So that's been a continual process. And overall, you'll be comforted to know that this is added value. And for New York City, we do some customization in 3 asset classes where you're a little bit different than the market. So on page 110 are our base assumptions. This is what we use for, I don't want to say our normal client, because that would mean you're abnormal, for most of our clients. And as I said, we'll spend more time on the customized numbers for you. But there's a few things I want to point out on this page. If you look way to the right, those are the most recent numbers. And the most important thing in our work is what we call the equity risk premium. And that's the difference between the large cap return of 8% and the fixed income return of 2.8%. That's the return premium you will be paid, or we think you will be paid, for holding equities rather than bonds. And at 5.2%, I can tell you that's the highest the equity risk premium has ever been in our work, which again goes back to '94. The old high was 4.9. Now, why is it high? It's not because we're super bullish on equities. If you look at equities at 8% and inflation down at the bottom is at 2.4, that's suggesting a real return of 5.6. So the average real return over the last 90 years has been very close to 6%. So it's not saying we're bullish on equities, it's just saying that the bond market yields are historically low, that 5.2 equity risk premium. The other thing I'd point out is that large cap and EFA assumptions are the same at 8.0%. They get there in a very different fashion. And I'll explain that a little later. And the third thing is you see gradual reductions in the equity classes between November 2010 and today, sharp reductions in fixed income, but the real estate return number hasn't gone down. It stayed at 6.6. So in our optimization work, real estate is becoming more attractive as the diversifying asset in the portfolio.
What is that international line at the bottom, Terry?
That's inflation. That's a typo. I'm sorry.
And just as a reminder, this is about a 5 to 7 year forecast?
No, this is a 2 market cycle, so 10 to 15 years. Very different from what your actuary is doing, which is a 50-year horizon, but very different.
But his are much more certain than yours.
So on the next page, I just highlight some of the observations I already made, but I want to spend a second on the last bullet. So we get to the same return expectations for EFA as we do large cap, 8%. but they get there in a very different fashion. So the dividend discount model has three inputs. One is expected GDP growth. The second is current dividend yields plus expected buybacks, companies buying back their own stock. And the third component is inflation. Now, the inflation expectations in both regions are about the same. Where they're different is in the first two. In the United States, the dividend yield is about 2%. We're expecting about 1% of buybacks, so that component is about 3%. The expected GDP growth is 2.8, just slightly south of 3%. In Europe, the expected GDP, or in IFA, in Europe it's almost zero, but the other parts of IFA bring it up to slightly less than 1%. So 1% growth versus basically 3 in the United States. But the dividend yield on IFA is north of 4%, where our dividend yield is 2%. So they get to the same place, 8%, but in very different fashion. On the next page, we see the expectations adjusted for New York's portfolio. So we have a core plus 5 adjustment to the Barclays aggregate, or the average core manager for other clients. We have a 50-50 blend between core and opportunistic real estate. And we use a slightly higher hedge fund expectation. So we see some of the same patterns, a very high equity risk premium, but reductions in the fixed income categories to the tune of, 40 to 60 basis points, and 10 to 20 basis point reductions in the equity asset classes. Bottom line is the bottom line. If we were to calculate the expected return on your asset allocation, it would be 7.6 today versus 7.8 using the November of 2010 numbers. Now, let me tell you what's different about this set of expectations and why it's what I'd call abnormal. If we were in what we call equilibrium pricing for these asset classes, I would define equilibrium as a situation where cash yields are about 1% over inflation, and bond yields are about 2.5% over cash yields, and expected equity returns are about 3% over bond returns. Today, cash yields are negative. 2.4 inflation, about a 1% yield on cash. You've got bond yields about 1.7 ahead of cash instead of 3. And then our expectation on stocks is 5.2 over bonds, where normally it's about 3. So when we talk about building a more risk-balanced portfolio, which was sort of the subject in the asset allocation studies, at this point in time, it does make sense to wait until we get more normal to make those shifts to reduce the equity risk exposure in the portfolio. Finally, on page 113, now the total fund reduction is really due just to the cratering that we see in treasuries and tips. The corporate bond market yields aren't off that much. And I believe, especially after the action in the bond market in the last 4 weeks, that from a tactical perspective, it would make sense to move to the bottom of your ranges in the sovereign debt and the TIPS areas, which I think you're doing. That is a sensible positioning in this market. And I'm not supposed to do that, but I just think it's so out of whack. But this is one of those times you take a position.
So this is a normal forecast. We live in anything but a normal world. what is your confidence, conviction in this forecast relative to a year ago?
Well, I spoke at a conference in April. You were there, but you walked out early before I spoke.
Missed your words, Mr.
She took a call from the mayor.
And I said about the same thing I said today, that if there was any overpriced asset in the menu, it was sovereign debt and tips. So I've been dead wrong for 5 weeks. So I wouldn't place a lot of confidence in my predictions based on recent results. But if you look back over the 19 years that we've been doing this, the results are pretty good. Now, 35 to 70 basis points doesn't sound like a lot, but if you got that much excess return out of active management, you'd be very, very happy. So the answer is, on a year-to-year basis, confidence should be fairly low. But if we're looking out over a market cycle, your confidence should be above 50% in our forecast. Or our confidence is above 50%.
Here's one thing that concerns me about the way you played up your, or built up your DDM forecast, is the EFA 1% is in part at least a reflection of austerity policies, right? We could be headed that way right here. And so that 2.8, I agree it's a 10 to 15 year forecast, but for the foreseeable future, that might be a very ambitious number here too, making equities that are obviously growth sensitive. Just not, that premium could widen, in other words, right?
What we're using in both cases is it's called the Blue Chip Economic Forecast. It's a survey of 52 leading economists, and it's an average 10-year number.
It's just very hard for me to imagine that Europe will be that depressed for that long and we will do just fine. It's just very hard to see that relationship. Sobering, but not very different, certainly in terms of a long-term forecast than the last time you presented, yes.
Okay.
So you're glad you stayed this time?
Always want to hear Barry. My kids come first, though.
Any questions?
Okay, thanks, Barry. Martin?
Yes. So we have an item here on the agenda, starts in your book on page 115. And this is to refresh the board on what we talked about starting, we brought this to late 2008, about bank loans. Because we're going to be bringing some more information to you next month about bank loans. So we want to definitely talk to you about characteristics, what they are, and so on. It should take about 15 minutes or so. Plus or minus, plus any questions that so please interrupt me with any questions that you have along the way. I apologize, this is in black and white, so some of the charts have lines. Fortunately, they look darker and lighter, so we'll be able to refer to that. I don't have color handouts for you. So, like I said, it starts on page 115, and bank loans, you'll recall, we first brought it to you at the end of 2008 during the depths of the financial crisis, when bank loans were trading at levels that had not been seen in its modern history, and so opportunities were there. The reason we don't have bank loans in the portfolio presently, or up until then, was because, according to the law, New York State law, it doesn't permit them to go in the basket. Again, this is one of those areas where it's not intuitive. We allow high-yield bonds, and we'll go to this later. We allow high-yield bonds in the portfolio that have less protections and lower recovery rates, but bank loans have higher protections and higher recovery rates, but are not permitted in the law. When the expected return got higher on an unlevered basis, we came to the board, I believe it was November or December of 2008. The board then allowed certain of our high-yield managers a limited allocation in bank loans, and we did that. Managers did that, added value, The problem, though, now is that because this is a non-benchmark that is not in the benchmark, and the overall expected return is slightly lower for bank loans and high-yield bonds, all things being equal, while certain managers have up to a 10% allocation, they're not up to that, and they haven't been up to that level since early '09. And we took a look recently at the managers that are presently in the high-yield program, and of the 5 managers that Police has, only one of them had any bank loans. And that was a very small amount. So we would call this a de minimis allocation. And it's not surprising because it's not in their benchmark, and it has a lower expected return, so it have to be security-specific reason why. So I'd like to start with the name. Let's get the name right. These, you'll see on page 2, it says, on the top, it says high-yield bank loans, a.k.a. leveraged loans, basic characteristics. Bank loans go by different names. And you'll read about it, we'll talk about it, and so let's get the name right. So we're here in this presentation referring to them as bank loans, but they're also known commonly throughout the industry as leveraged loans. They're also known as senior loans, they're known as syndicated loans, and sometimes they're known simply as loans. We're all referring to the same thing, and specifically for this presentation we're referring to performing loans. So that's similar to our high-yield program, which we have presently, where they're performing loans, where we don't permit, or generally don't permit, distressed or bankrupt securities. So these are referring to loans that are paying, just like high-yield bonds that are paying. So the important thing is, I think to start, take a look at page 3 and where they fit in the capital structure. And I apologize for the hard-to-read graphic that we have on there. So if you look at this as a private equity deal, or any deal actually, loans sit on top. What that means is, in the case of Chapter 11, or in the case of very commonly where, because loans negotiate typically with the issuer to have covenants, strict covenants on asset coverage, interest coverage, and other financial ratios, the issuer will be required to negotiate with the lenders to give them waivers for that in exchange, obviously, for a higher rate of interest. But if you look at this as a private equity deal, if you see on the bottom, we own the equity. So we own private equity, and we own, obviously, the equity in the public markets. We own the bonds, which are typically high-yield bonds. And by the way, the leveraged loans are used to pay for the takeout of LBOs. But on top, the loans, the bank loans, which are senior in the capital structure, get paid off first, and in many cases 100 cents on the dollar, although not every case. We don't own any, except for what I just mentioned in our high-yield portfolio, which is a de minimis amount, and that's because of the basket. So it's a very odd situation that we own the equity, we own the bonds, but we don't own the loans. So it's a missing piece in our portfolio. I'd like to turn to the next page to describe some of the important characteristics of bank loans versus high yield. We have a graphic later on in a future page that's coming up that shows quality. So what we're referring to here is below investment grade investments of companies. In other words, below BBB. They're rated mostly BB, single B. There are some triple Cs. There is a very small smidgen of triple Bs actually above or in investment grade. But for the most part, they're in the category of below investment grade along with high yield. The top 2 points I mentioned before, these securities are at the top of the capital structure, as we mentioned back in 2008. They are senior, and what that means in many cases, not only are you first in line if something goes wrong officially and it's taken to Chapter 11, but unofficially, as creditors discuss with the lender, or the borrower, I should say, if covenants are tripped or about to be tripped, that the holders of the bank loans receive something in exchange for that. Compared to high yield, which also have covenants, bank loans have many more covenants and much more detailed, and so that protects the investor. You'll read about sometimes they're referred to as covenant-light deals, and that's typically when investors have a voracious appetite for bank loans and for high yield, so issuers are able to get away with issuing bonds or loans with less protection for investors because that demand is there. But in general, over a cycle, loans have more protections in the form of covenants for investors. Bank loan, high yield has them as well, but to a lesser extent. A very important part of this, as far as this priority and security, is that bank loans many times are secured by specific properties or assets, in addition to being first in line. So, for instance, I use this example with other boards. A very large component of the industry is gaming, casinos. So in bank loans, in many cases, you have in leverage buyout, or whether it's just a loan that's issued, the loan itself is guaranteed by the assets of a specific casino or a specific asset or property. While high-yield bonds can have the same thing, this is very common with bank loans. Very important other points that we mentioned before is amortization. What that means is bank loans pay down over time, whereas the structure for high-yield bonds is very similar to treasuries. They're 5 or 10 years, sometimes 7 years, but generally 5 to 10 year maturities. They're bullet maturities, which means you get paid your entire principal back at maturity, just like a treasury, and every 6 months you get interest. There are other aspects and different types of securities, but in general, that's what high-yield bonds look like. What that means is, because of duration, interest rate duration, if interest rates go down, bond prices go up. If interest rates go up, bond prices go down. And so high-yield bonds, because of the nature of the below investment grade companies, as well as the sensitivity to interest rates as measured by duration, the price is very correlated to the cyclicality of the business cycle. Whereas high-yield loans, because they are paid off first, or generally first online, there technically should be no reason why it goes below a certain level, meaning below a level that is expected to be paid off if something went wrong and it went into Chapter 11. Which is why historically high-yield bonds trade all over the map, because recovery rates can be as low as 0, but historically are 20 to 40 cents on the dollar. Whereas loans, historically, it's about 70 to 90 cents on the dollar. Because of that, they trade on a range, except for what happened in 08, which we'll go through in a moment. Last factor that we have here is that high-yield bonds have call protections. So for a certain number of years at the beginning, there's no call. In other words, even if interest rates go down, investors get to keep the bonds for a certain number of years and benefit from duration. So prices can go up well above par. But with high-yield loans, bank loans and leveraged loans, the loans typically, if they go above par, they'll get prepaid, and they'll get prepaid without penalty. There obviously are exceptions to this, but that's why the price of the overall index will pretty much top out at par, or 100, and we have a chart later on that shows that. A very important feature that we have here is the very first item that we mentioned here, and that's floating rate versus fixed rate. Most high-yield bonds, and when I say most, I'm talking about well over 95% of high-yield bonds, either pay a fixed rate of interest, as I mentioned before, like treasuries, and you get your interest payment every 6 months, and at maturity pays off or it gets refinanced. And I can tell you from experience that high-yield bonds, there's almost no cases of high-yield bonds that actually pay off. They almost always get refinanced or bought out in an M&A activity. But bank loans pay a floating rate of interest. Again, the vast majority. There are some fixed rate, but that's a very small minority. What that means is, when, as I mentioned before, interest rate duration, when interest rates go up, the bond prices go down. When interest rates go down, the prices on bonds go up. When you have a floating, that's for fixed rate. When you have a floating rate of interest, and generally these floating rates are reset monthly or quarterly, what that means is, if you take a look at the very next page on page 5, we have a chart that shows duration versus yield. What this means is you're collecting your yield, but the interest rate duration, whether interest rates go up or down, have very little effect on the price of the bond itself. In fact, when we circle it here for you, the leveraged loan index, the Credit Suisse leveraged loan index, which is the main index that is used by most institutional investors, is another index called the LSTA index, S&P LSTA index, which is sponsored by S&P and the Loan Trade Group. As you see, based on the CS index, it has the same duration, interest rate duration, roughly as a 3-month Treasury bill, which makes sense because it resets on average about 3 months. What that means is you actually benefit from rising rates, whereas all other bonds, fixed rate bonds, you get hurt by rising rates. And the reason for that is because when rates go up, this will get reset at a higher rate, and you will benefit from that. And so all of your other investments in the Core Plus 5, high yield, while there are exceptions in specific securities, for the most part, interest rate duration is a very important risk of bonds. Three major risks of bonds include interest rate duration, spread duration, which is are investors seeking or avoiding investments in this particular risky asset versus treasuries, and you also have credit risk. Are you going to get paid at maturity, and are you going to get paid every 6 months? So the floating rate aspect of bank loans is a very important feature because of the fact that it actually benefits you when other bonds it hurts you. Now, while I said it benefits you, these are below investment grade, so the fact that a below investment grade company is now paying a higher rate of interest hurts their financials, but because you're first in line, your recovery rate is higher than what you have in bank loans, in high yield bonds, and we'll show you that in the coming slides. So the next two slides show recovery rates and default rates. And the light line, I know, I'm sorry about the colors here, but the light line refers to loans and the dark line refers to bonds. So let's start with the page 7 first, before page 6. Default rates, both of these default. They're below investment grade, so you will have defaults. And those are based on mostly cyclical business activity. So when there's a recession, you have more defaults. If there's a particular idiosyncratic issue with the company, you'll have a default. But mostly it's very pro-cyclical. But the real question is not a default, but defaults will happen. It goes through the normal core process of Chapter 11. What will you recover? And as you see in the chart on page 6, the light line refers to loans. It's 70 to 90 cents on the dollar. What happened in 08 actually brought down the historical level. We start with 99. We went back 20 years, and the number is actually closer to 90 cents when you go back further enough. But where we are today, it's probably about 70 cents on the dollar. You'll see an anomaly on the chart. This came up at previous board meetings, about 07 on page 6. You'll see that for a very short period of time, bank loans had a lower recovery rate. And the answer to that is if you turn to page 7, the very next page, you see that the overall level of defaults was extremely low. It was at an historically low level that had not been seen before. So there were so few defaults that the very few defaults that occurred skewed the numbers. And there was one particular default, Nature, which was a fraud case, that loans obviously got hurt. And because there were very few defaults, the numbers got skewed. But for all other cases, you would expect recovery rates to be higher than default rates. And in fact, that's what we've experienced in our portfolio. Next couple of pages just show some statistics about spreads, double B, single B, triple C, as you might expect. The top line, which is the darkest line, is triple C. It has higher spreads. Lowest line is double B because it's close to investment grade. Has closer spreads. So I'm sorry, I said it backwards. Triple C's have higher spreads, and in other words, to get paid for the risk that you're taking. And double B's have less risk, although it is below investment grade. The next page on page 9. Most or much of historically the issuance of bank loans come from LBOs, but not all. And this shows historically where you were. If you look back in 07, the spike up where it reached nearly 80%. If you remember back in 07, the question was which companies are going to be taken out, single A companies that private equity firms will take out, put debt on, become below investment grade, and turn into a leveraged buyout. So it comes and goes. Obviously, these days it's much more difficult to get financing, as Barry would tell you. But the reality is much of the issuance has to do with new issuance as well as LBOs, leveraged buyouts, which feed a lot of the investments. As far as the size of the market goes, that feeds into page 10. The size of the market historically was roughly about the same as the high yield market, about $1 trillion. But a few years ago, there was more bank loans. Bank loans topped out at about 1.6 trillion, and high yield was roughly about $1 trillion. But because of the Fed's actions, because of lower long-term rates, what a lot of bank loan issuers have done over the last several years is taken advantage of lower rates and have retired their bank loans and issued longer-term high-yield bonds, senior bonds, again, first in line because now there are no bank loans, to take advantage of historically low rates. So the overall level, depending on what you look at, is probably $600 billion to about $1 trillion. $600 billion goes to what trades every day. $1 trillion goes to what's on the books of the banks, as well as other areas of the bank loan market. I know the page on page 10 is hard to read, but if you take a look at the middle part of the chart, what we're trying to show here is who owns bank loans. And until very recently, the middle bar, as you see in 2007, it says 57%. It's very impossible to see which is which, so I'll describe to you what it is. It's CLOs. CLOs are collateralized loan obligations. They're investment vehicles. They're legal entities that are created to buy bank loans and use leverage to increase the returns. Bank loans traditionally were the ideal vehicle for leverage because the price didn't move much until 2008. So because the price didn't move much, it was an ideal candidate for leverage because you won't get a margin call if the price is nice and steady. And so two-thirds of the market going back further than this, and in 2007, 57% of all institutional loans that were held outside of banks were owned by CLOs. That number has declined to 38%. We would expect that number would go down further. Who's taken up the slack? It's been pension funds like the police pension fund in either dedicated or opportunistic areas. And by the way, we're talking about here performing loans, as I mentioned before, not non-performing loans, which would go in our opportunistic category. Performing loans can also go in. As Barry could tell you, institutional investors on an unlevered basis are looking at loans to supplement or to complement their existing high-yield portfolios. There are also bank loans in hedge funds, there are bank loans in mutual funds, bank loans that are owned by insurance companies, lots of them. But the reduction in CLOs, the leverage number one is hard to find, and investors number two aren't interested in leverage in many cases. And so these are leveraged loans that go into typically pension fund portfolios. So what I just described to you is a case that sounds awfully good. It sounds it's similar to high yield, but you benefit from the floating rate if rates go up. You're first online to collect if something goes wrong, so what's not to like? Page 11 shows that there is obviously a price to pay. And the price to pay is that you have a lower expected return. You also have slightly lower volatility. So with low return, you get volatility. Now, the numbers here for the standard deviation on the left, as well as the right, quite frankly, are skewed by what happened in 2008, where on a future chart will show bank loans went down to prices near 50 or 60, which had never been seen before. They typically never been priced below 90. And so the standard deviation numbers are skewed by that, but if you X that out, which of course you can't X that out because it's part of life and it's part of the history of bank loans, the standard deviation is in the low to mid-single digits because it basically traded between, I'm talking about performing loans, traded between 90 and 100. But again, the return is lower because you're first in line. So because it's a safer investment in exchange for taking more risk with high yield, you get a higher expected return. Quality allocation is on page 12, and it's virtually mirroring what's in the high-yield universe. You have double Bs and single Bs, you have some triple Cs, you have some non-rated, and you have a smidgen of triple Bs. In the high-yield index, you have no triple Bs. There are some split-rated securities, meaning between Moody's and S&P, but the Credit Suisse index actually does include some triple Bs, but it's 2% or less of the overall index. The next few pages are very difficult to read. All I'll tell you about the next few pages is they show returns of Russell 3000 high yield and bank loans over 5, 10, 15 years, and we can go over that later, or we can send that to you. But basically what it shows is that the high yield returns are higher than bank loans, which is what you would expect. I mentioned the prices. This is a very important chart on page 16, and this goes back 20 years. So the chart, the line that on the left starts on top is the chart for bank loans, and the chart that goes way down and way back up is the chart for high-yield bonds. As I mentioned, high-yield bonds are very connected and correlated to the cyclicality of the business cycle. And so when companies default, or if they're It's a feeling in the market that
Which one's high yield?
it's very hard to see this here because of the color.
On the right,
So on
the top is high yield, or the top?
So the one that goes very high and very low is high yield. The one that's more steadier, although in 2008 does decline. So for instance, in 2008, the line that's a little bit higher
Yeah.
is bank loans. The line that hugs, basically that goes between 90 and 100 is bank loans. The line that goes way up and way down is high yield. It's harder to see this because it's black and white. In the package that we sent you, you'll see the colors that will straighten that out. But effectively, if you take a look at the line, say in the 90s and in the aughts that go from 90 to 100, you see that for a very brief period of time in 2002, when it went below 90, very slightly below 90, high-yield bank loans traded between 90 to 100, and for the most case, they were very near par. They never went quite above par, because above par they get redeemed. But they're first in line, and if something goes wrong, they can collect up to 100 cents on the dollar, depending on the industry, but depending on the assets the company has, and depending on the cycle where we are, and the type of company that they are. So high-yield bonds obviously have a lower recovery, 20 to 40 cents on the dollar, so there is more risk there, and so the prices go up and down much more severely with the business cycle. The key takeaway here is that right now prices are about 94 cents on the dollar, which is below historical averages when you X out 2008. As you see, for much of that time it hugged the par line because the expectation was that you were going to receive back what you had, and there was demand for it. While the recovery rate may have been 90 cents on the dollar, there was higher demand, so it pushed prices up. Recovery rates these days are about 70 to 90 cents on the dollar. As far as spreads go, on the next page, it looks like the numbers are on top of each other, but it is slightly apples to oranges. The high-yield index spread is off of LIBOR, and it's generally off of 3-month LIBOR, whereas the high-yield spreads are off of treasuries. So LIBOR right now is, as Larry showed in the book here that we have here of these color charts, LIBOR, 3-month LIBOR is about 47 basis points. Because LIBOR is so low, investors have, in many cases, demanded LIBOR floors. So there's the way these bonds, these high-yield bank loans get priced is it's LIBOR plus a spread. Because LIBOR is so close to zero, investors are saying, okay, if it's below 1 or 1.5%, we get at least 1 or 1.5 plus the spread, which is, say, about 500 basis points. For high-yield bonds, they're priced off of treasuries, so they're 500 or 600 basis points, as we show in the chart there, and recently it's gone up. So the spreads are a little bit apples to oranges. And as far as the yields on the next page, again, apples to oranges. The yield to maturity we show for high yield, it's a higher number. I know it's hard to read, but it's a higher number. And the yield right now is about 8%, Barry. Does that sound about right for the high yield index? It was below 8% recently, late in winter, early spring when high yield was hot. High yield has come back down a little bit, so spreads have come back up. For bank loans, they're priced off of LIBOR, and the bank loans, we cut this chart off for the latest run-up in yields. So yields are now above 5%. They're in probably mid-5s. That sound about right? However, the difference is, like I said, apples and oranges. The yield to maturity is used for high-yield bonds, but current yields are used for the loans. The reason current yields are used and not yield to maturity is because the yield to maturity is unknown because they reset. As I mentioned before, bank loans reset every month or every quarter depending on the loan, and so we use the current yield here. So where do we own these in the portfolio? I mentioned to you that we talked to the board, and the board approved certain high-yield managers to own them back in 2008. They did, in fact, own them in 2009 when they were great values, but they have since sold them except for one manager. So we really don't own them much, and the reason primarily is unless they are screaming value, they're not in the benchmark, and it's non-benchmark bet, and they have lower yields. Our opportunistic fixed income managers can own performing loans, and they can own non-performing loans. We have, for instance, Avenue in our opportunistic fixed income portfolio, and they own non-performing loans for the most part, where they will trade the bonds, and in some cases they'll be involved in the restructuring. But we also have opportunistic managers who can buy performing loans and lever, if you remember the policies, to lever up to 1 time. to increase the return for even performing loans. But our opportunistic program is still in the stages of being built out. We're going to be bringing to you some more information and a recommendation on bank loans next month. There's no action item here. This is just information for you in case you have any questions and to prepare you for next month. Unless you have any questions, that's my piece.
Maybe I can summarize this a little. So, if you think about one of the things we want to do is continue to diversify the portfolio. So there are these things called bank loans, which are also known as leveraged loans, which are in non-investment grade credit. We own high-yield bonds. These are senior to the bonds. We don't own any of those. We own the equity in the private equity fund. So it's sort of like missing on the menu. We should have it. Since they're the senior most security in the capital structure, they're less risk, so you get paid less. So it's one of these diversifiers. It's fixed income. It's less risk than the high-yield bonds. We've done terrific in high-yield bonds over the last 10, 15 years. These are floating rates, so they're good, so they have less volatility overall. So it's low return, less volatility in names that you're probably already an investor in, either through the private equity or the high-yield bonds.
You can refer to these as pure credit risk because of the floating rate.
So when Martin went out to do the high-yield RFP, as we were putting it together, we said as long as we're out with that, there's some managers that do the same thing. They have high-yield desk and they have a leveraged loan desk. Let's make it a double RFP. So we've done that. So we're coming back to you next month with the results of that RFP with managers, and as well as changing the IPS to let us do bank loans, etc.
So last month was high yield. Next month we'll come to you with bank loans.
The only odd thing is, and this really is odd, in the basket language, you can't do bank loans. Or put another way, it counts against the basket clause. Whereas other things that are riskier don't.
High-yield bonds.
Like high-yield bonds.
High-yield bonds actually in some cases do go in the basket, but we craft our guidelines to avoid the basket-related items other than in the high-yield book.
Can't be done.
Is it maybe about time that, I guess it would be your office to engage the state controller to begin to look at, the basket clause issues? I know we were looking at maybe try to get them to raise it, but maybe you want some further clarification to make sense of the basket clause in today's world. Someone like you just said, there are things that are riskier that are not in the basket clause, and things that are less risky in the basket clause.
So let me give you the reason why it's not permitted in the basket. The basket, the law says that securities must be registered with the SEC. These bank loans technically are not securities. They don't have CUSIP numbers. They're stacks of documents. They're loan documents. Even though in court they have superiority in first claim versus high-yield bonds, the trade group, the LSTA, has been working for several years to make them DTC eligible and to create CUSIP numbers to make them actual securities. We're probably several years away from that happening, so we're not there yet. And also it can take several weeks, 2-3 weeks, just to settle the securities because of those issues.
But if there are other assets that are less risky.
High-yield bonds.
High-yield bonds that are, okay, so maybe we would need to at least ask you guys to engage in that conversation with the Monopoly's office.
Relative to your question, which I think is a good one, it is something that we're looking at. And, we originally had some conversations about possibly trying to accomplish something this legislative session. Obviously, it's June, it's not going to happen, but it's on the radar screen for something that we need to do as we sort of try to move our portfolio forward next session. So we'll be in touch with the board as to the plan.
I think we'll come back to you guys with the plan, have you approve it, just so we're all on the same page as what we're going to go to Albany with, and that'll be in charge of the project as to how you get from here to there and talking to the other state public pension funds in New York to coordinate. All right. Any other questions on leveraged loans? Great. Thanks, Martin. Next on the agenda is an overview of European real estate. Let me bring the people in. So I'll tell you, while she's bringing the people in.
Hold on a second,
While Carol's handing that out, I'll say a couple of words and we can move on. So as you know, we've made a substantial commitment to Blackstone's real estate fund and Brookfield's real estate fund, both of which have the ability to invest internationally. So there was a request that we should have an update on what's going on in the European real estate market, particularly since I presume that some of that capital we've committed is going to go over there. We might also make some more investments in Europe as well in the next 12 or 18 months, so I just think it seemed like a good time to do that. So we have people from Townsend, as well as one of our REIT managers, Cohen and Steers, who's going to give us a presentation. And I'll turn it over to Townsend.
Yeah, sure. Good afternoon, everyone. My name is Tom Bojayan. I'm Senior Portfolio Manager at Cohen & Steers, managing both U.S. REIT strategies and global strategies. I'm going to spend maybe about 10 or 12 minutes just talking about the European economy and how that outlook translates through to really real estate fundamentals. As I'm sure everyone reads every day, the general conditions in Europe are challenged. Certainly there's a bifurcation of those markets in Europe. The Northern European markets generally have better economic conditions, and the outlook into late 2012 and 2013 is benign, but we don't think there's going to be really a major recession within those Northern European countries. As you get to the periphery of countries like Italy, Spain, Portugal, we think there's some challenges ahead. Greece, obviously, there are some challenges ahead. Our internal view is that for Europe overall, we're calling for a modest recession for 2013. So we think there's going to be about 1% negative growth in Europe. Now, we think that countries like Germany, the United Kingdom, and France, we're going to have very modest growth. When I say modest, I mean 1 to kind of 1.5% growth. So we're going to be running what I would characterize as kind of stall speed. But we still think there's economic growth in those markets. As you get to Spain and Italy, we think you're going to have not deep and not long, but you're going to be in a recessionary-like environment. And there's certainly a lot of causes as to why we believe that to be the case. Obviously, we have a debt crisis that there's mixed views about how we resolve them. On one hand, there's you can do that through fiscal measures, and there's monetary measures. And there's no clear consensus view today as to what the right solution is. And so when I think about that in the big picture, there's really a wide range of outcomes. And so as we're investing in Europe, we're being very selective about how we do that. And why don't I just talk a little bit about the countries that, the type of countries that we're investing in as an equity investors, as I'm not sure everyone knows here, we're the manager of real estate equities. So all of our investments are in listed real estate companies in Europe. If you look through to our portfolios, we're really investing in markets like the UK, Germany, and France. We have very little, if anything, in what we call the periphery markets. We're focusing our portfolios to really what we consider the strongest economies of Europe. You know, Germany, as everyone here knows, is really the strongest economy in Europe. It's been characterized by what we believe is low unemployment. We're really at the lowest levels of unemployment in Germany, and good wage growth, and that's translating into good real estate fundamentals, and we'll talk about that a little bit. In France, as I'm sure everyone is aware, we've had a change of leadership from Merkozy to Hollande. He's much more focused on a balance between growth and austerity. If everyone rewinds about 6 months, you know, really the viewpoint was that the way out was through cutting. And I think there's a better balance today of you can't cut your way out of a recession. You really need to put measures in place to grow yourself out. And I think Hollande is, even though he's a socialist, is really bringing that to the forefront. I think that will be much further, those types of conversations will be further advanced as we move forward. You know, the United Kingdom, it has fallen into what we call a technical recession, 2 quarters of negative GDP growth. They have more flexibility, obviously, to address the issues within that region of Europe. It doesn't have 17 other countries that need to agree to policy. It's only one. And it's our view that there's the potential for further quantitative easing as the growth outlook deteriorates. I'm going to spend the next 5 or 10 minutes, 5 minutes or so, just talking about the property markets. It's the 4th page of our presentation. It is a low interest rate environment that's very supportive for real estate values. One of the things that we like to look at as an investor is what's that spread between what your initial yield is, what we call a cap rate, and the financing rate. We use the BBB as a proxy for that. Today, despite what is happening in Europe, there is the availability of capital, debt capital, to the best borrowers, and those tend to be the well-capitalized real estate companies or REITs. And thus there's a very positive spread between where you can buy an asset and the return you would receive on that and where you can finance that. If you look back over history, that spread has been much narrower. And that could imply, one, that cap rates or the yield requirement that investors would want could be lower than it is today, and thus capital values would rise from here. It also could mean that interest rates are somewhat artificially low, that there's been policies put into place that have kept those interest rates low. We think it's a mix of both, and our view is that there is the ability for capital values to rise for what I call prime real estate. Those are assets that are in really the best core markets in Europe that I characterize, you know, the City of London, the West End, Paris, and then some of your major German cities, both on the commercial side, meaning office, retail, even industrial, and then somewhat on the residential side. There's not a huge listed market for residential outside of Germany. Where we prefer to invest our capital really is in that prime office in retail sectors. We think that those type of cash flows are going to be the most resilient, even in the economic uncertainty that we have today. If you think about the lease structure in Europe, they tend to be longer lease structures, so there's some security to those cash flows. Obviously, it's important to understand the credit of those tenants. As we think about investing, we're thinking about lease duration, we're thinking about underwriting those tenants. They tend to be in those core markets where there's a deep pool of capital that wants to own that type of real estate and a deep pool of tenants that want to be in that real estate. When we look at real estate values in Europe today, we believe that the listed market trades at a large discount to the underlying value of the real estate. And what I mean by that is that we can buy, put it in simple terms, $100 of real estate for 85 cents in the public market. That the public market is discounting the value of unlisted real estate today because of the uncertainty that is in the market about the economy and what the ultimate flow-through is to real estate fundamentals. We believe that's an opportunity today. Our portfolios are positioned to be market weight to Europe, despite all of the uncertainty. We had been underweight the continent and the UK. We believe today that if you have the right time horizon, that you want to be investing in Europe. But you want to be investing in core real estate, the periphery, as I would call it, either by country or type of real estate, secondary markets. I would characterize it as suburban here if you're thinking about it in the U.S. context, but you want to be in core. Just going quickly through a couple countries, Germany, we really like the residential market. There's been a number of transactions. There's greater liquidity in that market today. We think that in the listed space, these companies can use their capital to buy assets below replacement costs, and that's really important. And we believe that will persist for some time because there's enough of a gap between where rents are today and where they would have to go in order to make new construction feasible from a risk-adjusted return basis. In France, we're very much focused on Paris and prime real estate, prime retail real estate. And again, our focus is on companies that own that type of real estate and have balance sheets that can sustain them through what will be some uncertain times. And then finally, before I turn it over to Nick, we do like the UK. Dovetailing my comments about the ability to manage the economy better than the continent, in the simple fact that there's a tremendous amount of demand, both from capital, foreign capital wanting to go to Europe, go to the UK to buy prime, and we believe that we can do that at discounts to asset value. So with that, I'll pass it over to Nick and be happy to answer questions after.
Okay, thanks, Tom. As say, my name is Nick Cooper, and I work for the Townsend Group. So I'm going to work off that second presentation. As you can probably tell from my accent, I am a Brit, so I'm not sure whether that makes me more involved in that market or not. But I'll give you my personal insights and the view of how we see things. Some of the things I'm going to say will repeat a little bit about what Tom has just said as well. And that's good because we're really on the same page here. But I'll skip over a couple. I'll also focus a little bit more on, I think, one of the other key issues out there, and that's debt. Okay? Debt is a real issue in this market, and I'll explain why in just a moment. So if you can follow with me on that second presentation, I'll just, like Tom, I start with the sort of macro. I won't pick up anything that he said, but I'd ask you to focus on one thing: employment or unemployment. And in Europe, this is becoming a fairly serious issue. That little chart at the bottom shows you the forecasted average unemployment for each of the key countries around there. And the reality is unemployment, not surprisingly, in continental or in Europe is growing. We're up on average about 11% today. But if you go to markets like Spain, today unemployment in Spain, adult unemployment is around 24%. Youth unemployment is around 50%. These are tough days and are going to get worse before they get anywhere better. And on the grounds that employment really puts people in office buildings, it puts people in jobs, it puts people in shops, it's an issue you've got to be aware of. And I think that's one key thing that I would add very much to Tom's view of macro things as well. The other issue that is really important for Europe is what's going on regulatory with banks. You'll see my bottom bullet point on page 1 refers to something called Basel III and Solvency II, which I won't really go into explain because they're all too complicated for me to even understand. Suffice to say, it is putting serious pressure on banks, particularly in terms of their capital adequacy and their capital structure. And as you'll see in a moment, that has a profound implication on the market. So if I turn the page, and again following Tom's theme, we didn't actually compare notes, but we're pretty good here. European real estate markets, I also highlight these. That top chart is actually UK real estate pricing. And you'll see that peak in about December 2006. You'll see it fell very dramatically after a global financial crisis. And we've recovered a bit. But we're still quite a long way below those peak pricing. And I think that probably gives some comfort to entry point, picking up Tom's point. I think there's some comfort there that pricing is not full by any means in certain areas. But it's a pretty weak environment. What we've seen is a real flight to quality. Tom calls it prime, etc. You certainly see that. If you look at the bottom chart on that page 2, if you look at those yields in there on a relative basis, in many cases they're way below their 30-year average. Now that's helped by low interest rates, low bond rates today. But on that basis, it doesn't look that cheap on that basis. But against those bond rates, treasuries, actually there's some value to be had in there. The other thing we're seeing, and particularly I use this from wearing my London hat, is international money. There is a lot of money that has come into London from places, dare I say, seeking a safe haven, if that's what you can describe London as. So we see money come up from the Middle East. We see money come in from other parts of the Eurozone. It's just a lovely little stat that I saw last week. London residential, and I won't use it as an example, but London residential, one of the big London agents reported a dramatic increase in their website hits from people coming out of France worried about Monsieur Holland's tax on the rich, which is supposedly going to go to 75%. I don't know whether that's indicative, but it probably tells you the sort of things that are going on at the moment. And that is keeping pricing in certain things at quite a high level. Indeed, central London prices are well back at par, but peak levels. But you can't buck a trend forever. The reality is, yield has to reflect what's going on in occupational markets. And in the main, there are certain exceptions, but in the main, they are relatively weak. Corporates are not doing much, no surprises, they're all risk adverse, they're hoarding cash. Good for paying rent, not so good if you want to try and get rental growth. And we see that coming through in the market. I'm just beginning to see perhaps a little bit of softening in yield, that means value falling, in some of those key markets today. I don't think it's going to be a flood, but I do see a little bit of softening coming. And I think that's reflective of the issues that we've got going on in the market today. Before I get to debt, I want to just throw you two other, I think, interesting points, and that's on page 3. This chart on the left basically looks at private real estate funds in Europe. And it shows you the numbers that are coming to expiry in the next 2 or 3 years. Now, in theory, that real estate's got to come to market. Some of it will get rolled over, some won't come to market. But I certainly think there is a trend to see more investment in market. Second thing on the right is German open-ended retail property funds. These are what Herr and Frau Schmidt invest in and have been very popular in terms of that German market. Today, that market's around 90 billion euros worth of real estate. Today, a number of those funds are in trouble. A number will liquidate over the next period of time, and assets will come to the market. So I'm painting a picture that I think there's going to be more supply of assets, which is likely to therefore drag prices up, down, whichever way you want to go. So values will fall a little bit. I think that is going to come through the market at this point in time. And I think one needs to be aware of those issues and ensure you buy wisely. I turn to page 4, and I said at the start that I wanted to mention particularly debt. Debt is the vital lubricant to any market, be it real estate, private equity, just commercial business. Remove the lubricant and the wheels don't work so well. And that's what you see going on right now in Europe. Here's a really important stat to bear in mind. 75% of all commercial real estate is held by banks. Sorry, all commercial real estate lending, start again, is held by banks. That is a very, very different position to here in the US. Now, if your bank has some issues, and I'm going to show you those in a minute, you can see where the problem's going to come. So 75% of that held by bank. Of that, just under about 960 billion of commercial real estate debt in Europe, 500 billion is in the UK and Germany. Now, as a proud Brit, I, as you know, now own a share of the Royal Bank of Scotland. I also own a share of Lloyds TSB. And if I were to add in the bad bank in Ireland, 60% of all commercial real estate loans in the UK are owned by those 3 places. 60%. And 2 of those banks are either nationalised or semi-nationalised. You see the issue. You see what's coming. That is going to create a problem and also an opportunity. And how you exploit that is probably a conversation for later, but I think that there is some issue, opportunity that sits in there. Turn with me to page 5, and my little graphic shows the bank, and my little graphic shows you the issues that these banks are under. You start in the top left-hand side, you've got lending activity. Now, 2007 was probably the peak of commercial loan activity. 5-year loans generally, 2012 those loans are going to start expiring. Needless to say, bankers get a little bit greedy, so lending standards deteriorate when volumes go up. The other thing we see, there are less banks in the market. Eurohypo, SocGen, to name but two, are both out of the market now. Values still not come back. Values under pressure. And here's one of the other key issues that hit. If you're a bank today and you're lending above a 50% loan to value, so let's say you're higher than that 50%, that's going to require you to put out more risk capital on your balance sheet. They don't have it. They can't raise it in the market. They don't have it. That's where these banks are in problems.
How many of those loans are actually impaired or having some difficulty?
Well, I'm going to show you actually on CMBS in a moment how much is in there. Probably today, something like 20% of those loans today likely to go higher.
Steve, how would that compare to the U.S.?
Can you bear with me when I do the next one? Because I'm going to pick up the point for you in just a moment. If you go to the right-hand side, what you're also seeing, and take Spain, we all saw headlines last week, was it, that the Spanish government has to step in and inject 19 billion euros into Bankia, the big Spanish bank. Why? Because its property loan book is significantly impaired, and probably not really telling us exactly where the truth lies in that today. So I think you're going to see much more of that. And I think the issue that you're going to then see is more stock has to come to market with a consequence. Now, I put the last bit down there, and I mentioned that I, as a proud UK citizen, seem to own the Royal Bank of, or a portion of the Royal Bank of Scotland now. It has at least been trying to reduce its loan book. Its loan book was 2 years ago about £1.6 trillion. Today, it's down to £1 trillion. So I suppose it's got better, but it's still quite a lot. There's more to come of that. That will be a problem and an opportunity. Picking up your point, your question to me, I can answer it as well on this one, this slide of commercial mortgage-backed securities. Now, CMBS is clearly a well-known financing position here in the US. It is much less so in Europe today. 3/4 of those loans are in Germany and the UK, and again, the same scenario. What's in default? Just under 20% of those loans are in default today. And that's up from about 14.6% 6 months ago. So the trend is getting worse. Now, I can also tell you from a very personal experience, I sit on a small private fund in Europe, actually for Middle Eastern investors, and have done for 10 years. They have some properties in that fund that need refinancing. They're not foreign by any means. They're what I would call good secondary. We have one loan that's about to expire. I think we have a good manager. He cannot find a loan, period. No one wants to talk to him. No loan. Unfinanceable today. Why? Because the leases are short, he's got some vacancy, etc. These are issues for the market. Serious, serious issues that will come to that. And as a result of that, what we're going to see, I think, is some real opportunity for, dare I say, the vulture who sits on the fence. Because I think there will be some opportunities to play. I'm just going to show you a couple, just to give you a flavour of some of the things on our desk. This is page 7. This is a student accommodation. Student accommodation is quite a good asset class in the UK, it is. This is a heck of a lot better accommodation than ever I occupied as a student. This actually is being sold by Blackstone. You know that. This is Blackstone selling here. But there's an opportunity to put some debt into this, and that will give you a cash-on-cash return of about 11.5%. I think that's quite an interesting set of assets to get that sort of cash off. My next one on page 8 is Poland. Here, Polish shopping centres. Poland's one of the markets who's got GDP growth. It's about 3.5%. It's actually probably the best of the markets at the moment. Again, you can get the primary loan, prime, but you can't get the extra little bit. So this throws up another opportunity today in there. And the final one, recognising time, is on page 9. This is back into central London. A pretty good looking building here right in the city. It's coming out of Lehman's in bankruptcy, being bought out today. The current manager doesn't have enough cash to do tenant improvements. It's a story we see all over the place. And the yield on that today will probably be something around 10%. I've never, in the 30 years I've worked in real estate, seen something priced on that basis. An opportunity or a problem, whichever way you look. So, where do I get to my conclusions? I paint a pretty negative picture on Europe. And I make no bones about doing that, because that's how I see things. It's tough. It's really tough. But I'm still an investor. I still believe that there will be opportunity in here. And as I said, I've been around this European real estate market now for 30 plus years. This is probably some of the most interesting pricing I've seen in 30 years. You've got to be very selective. You've got to be very granular in your approach. But I think if you do that, I think there will be some opportunities to invest. I think all the ingredients are there for what I would call an opportunistic, a tactical opportunity to look at that market. But I completely concur with Tom that I think you've got to have a long-term view at it. It's not going to happen overnight. But I think if you are wise in how you invest, I do think there's money to be made. And I suppose the question, I'll preempt what I'm sure is going to be one of the questions to us. I actually do think the euro does survive. Because I actually think Germany cannot afford to see the euro go. Germany has done incredibly well from an export perspective on what is effectively a weak euro. It has made German manufacturing what it is today. If Germany comes out of the euro and we go to a Deutschmark, you're going to see natural currency appreciation as a result of that. That actually is not going to be good for German export, and with the rest of the market, they need the markets to be functioning to export to. So I think I think the euro does survive. Do I think it survives in its present format? I could see some changes going on, but hey, this is uncharted territory. You know, whatever I would say to you now would be crystal ball gazing, because I just don't see that quite where it's going to end up. I saw this morning a suggestion that Germany comes out and everyone else gets left. Maybe that's a solution, I don't know. But at the end of the day, I think politically you've got to keep that euro. But there's a huge political price to pay for that, which is something you have here in the US, which is political integration of finance policy. That is not there in Europe today. And that's the weakness of the country.
So with the sovereign and financial systemic risks that you both laid out, what kind of premium would you need to invest in Europe versus the U.S. for roughly the same type of core property?
Well, you've got to, you're talking an equity or a debt investment? Either. Well, I think you have to think about where the borrowing rates are by country in order to understand that, because take Italy, for example. A prime mall might sell at a 5% cap rate, but the sovereign debt yield is well north of that. So the way that I would think about it is from an unlevered IRR basis, and I think you do need some level of premium. I don't know whether it's 100 or 200 basis points when I would think about an IRR. And if I were a U.S. Investor today, I think that is somewhere in the 7 to 7.5% unlevered context. In Europe, depending on what type of market would, I'd say be probably a 200 basis point premium to that. So somewhere in the high single digits, and you might even get into the low double digits.
I would concur exactly with that position today. That's what I think the Europeans are. But, you've got to picture it's from, whilst you would be US money going that way, I think you've also got to see what pricing locals are going to pay for that sort of scenario. And I agree. I think for them, they're pretty risk averse at the moment, the institutions there. So they're probably in a hurdle rate today of probably in the 6% range is where they're going to pitch their scenarios. But they're very, very cautious about what they're doing. So I think it depends what sort of money you're taking with you to go overseas. But I would agree with Tom. I think it's about a 200.
And where you are in the capital stack
I would agree with that as well.
Is very important.
Very important.
So if you're at a 50% LTV on a debt investment, that's much different than I, who makes an equity investment. My return requirement should be much higher than what your requirement is.
With the banks so constrained, are there opportunities in next tranches?
Oh yeah, I think so. I think so. But you're clearly going up the risk curve by doing it.
But less risky than the equity.
Oh yes, certainly less risky.
Which is the sweet
Depends where the last dollar was.
It depends where your lost dollar comes in.
Yeah.
But if you take that example that I showed you of the student accommodation there, I sort of like that. I think despite everything, I still think people are going to go to college in the UK. Probably they'll do even more of that, whereas they can't get a job, so we'll defer and go to college at this point in time. As a parent in the UK, I know it's me who's paying the bill, not them, so, I think that's money that's going to go in there all the time. Do I think a sort of 54 to 65% in that sort of loan stack is good today? Yeah, I'd be looking at that. And did we look at that deal? You bet we did. That's a sort of 10.5%, I think it's 10.5, 11% number, cash on cash. I think that's not a bad position to be today.
So where this comes in our portfolio, besides the sort of more global real estate funds we put money in, is we're going to find some of the opportunistic fixed income guys who are buying the debt in Europe to take over the property. And we're slowly starting to look at some senior loans with some people that we should come in the very, very least risk, come in, make mortgages, first mortgages, and trophy assets, because the banks aren't lending. So if we can come in and get a good premium, perhaps hedge the currency, that might be a nice way for us to capture a little excess return in the least risk in the capital structure, and sort of starting to check some boxes for diversification as well to make sure we get the right returns. So we're looking at all that. Again, your capital's flowing there. You might not know it's in this room, but again, the Blackstones, Brookfields, the opportunistic fixed income guys, the money you've committed to them is migrating over to Europe and trying to figure it out. And it's complicated, and it'll take 2, 3, 4 years to sort itself out. But there's opportunity to be made, and money to be made. Any more questions for these two gentlemen? Perfect. Thanks.
Thank you.
So we're up to item number 6 on the public agenda, which is a item that was added to the agenda, handout. and you've seen the material before. Specifically, the material we provided was the memo from the actuary along with an accompanying draft resolution. So I'll turn it over to Bob, I guess, to frame the situation.
Yes, thank you. I appreciate the time here at the investment meeting. As you know, I requested that the board approve the recommended actuarial assumptions and methods, and the resolution is in front of you as it has been for the last couple of regular board meetings. The time is getting short here in that the legislature will be going away within the next 3 weeks or so, and the hope was to get the legislation and all the related items prepared and ready to go by the end of this week. Helpful to that would be the adoption by the board of the resolution in front of you. And so I respectfully request the board's consideration at this time.
We're seeking a vote today.
Yes.
I don't know if you're looking for a motion, but I'd like to move to approve the draft resolution of the actuary.
Okay.
Second.
Second. Like a roll call vote? Okay, we'll over to roll call vote.
Controller's office?
Yes.
Mayor's office?
Yes.
Finance?
Yes.
Police commissioner?
Yes.
PBA?
PBA cast all 4 votes against the recommendation of only receiving the legal section on VSF last night.
DEA?
Yes.
SBA?
Yes.
LBA?
Yes.
And CEA?
Yes.
Okay, it's so moved with the 7-12 vote.
And I thank the board.
8-12, sorry.
And Bob, we want you to know off the record, you managed to chase the Goldman Sachs rep out of there. She wasn't staying for this vote.
That ends the...
You gotta get out of the camera after that one.
That ends the controller's agenda for the public session.
So motion to exit public session and go into executive session.
Is that second? Second. Thank you, SBA.
Have a good one. Have lunch.